Welcome back to EDS, and in this video I'm going to show you one strategy that's going to change your financial life forever. If you are currently trading in options or anything like that, stop what you're doing, stop putting on new positions, don't place any new positions until you've watched this video. So we're going to be writing options contracts. We've got the corn futures up at the moment. We're not going to trade based off of the chart or previous price movements or anything like that. We've just got this chart up at the moment, and we're going to be writing options contracts, and we're going to be writing them on futures. That's going to allow us to get a very high return on our capital, as well as maintaining a very high win rate. So the first thing you want to do is open up a watch list of futures that have options available to trade on them, and then you want to make sure you have IV rank on your watch list, and you want to order everything from high to low IV rank. You only want to look for things to trade that have an IV rank of over 30. Over 30 is considered high. Over 50 is considered very high. I personally like to be in the mid to high range. And the reason why we like high implied volatility, or specifically a high IV rank, is because volatility plays a role on option prices. When option prices are high, when volatility is high, option prices are high, and we're going to be short these contracts. So we want to sell high, buy low, which means we want to sell when volatility is high. And IV rank tells us where implied volatility is for that specific underlying with respect to itself over the past year. So it's a very important metric. And if you have a smaller account, you probably want to stick to things like currencies, bonds, soybeans, things like that, as they don't require as much buying power as, say, something like crude oil. If you do have a larger account, by all means, just trade whatever you like. So we're going to take a look at the Aussie dollar today. It's currently trading at 0.6209. It has an IV rank of 63.5, an absolute IV level of just over 10%. So hopefully we can get some nice credit or premium on this. As we can see, the Aussie dollar has kind of taken a bit of a drop down. It's kind of been moving sideways recently. Sideways movement is good for us. However, the reason why we don't trade based off of the chart is because just because it's been moving sideways in the past doesn't mean it's going to keep moving sideways in the future. I just showed you this chart just so you can visually see the price movements, but we don't actually base any of our trading decisions on the chart. So the Aussie dollar, we're going to base our selection on the IV rank, and we know because the currency is going to require less buying power. This is a live account, by the way. So once you've selected your underlying, you then want to take a look at the expiration dates available for that underlying, and you want to pick an expiration date that's between 30 and 60 days out in time. And we've got April 4th here with 31 days left on the contract, so we're going to open that up, and now we can see the options chain. I'm assuming everybody knows what this is, but very quickly for any beginners, we have calls on the left hand side, puts on the right hand side. We have our delta columns on either side as well. Positive delta for calls, negative delta for the puts. This horizontal orange line shows us where the price of the underlying is with respect to these strikes that are going down the middle. We have our dotted blue lines above and below the current price, which show us our standard deviation levels. And in the top right, we have the implied volatility level, which is 10.6% for this specific expiration date. And in parentheses, we also have the expected move, which is currently plus or minus 0.01. And that expected move is also visually represented with this vertical orange bar. So it doesn't matter which broker you use or what platform you're using, you should be able to get this information up for all platforms. And if your broker isn't displaying basic things like the expected move, even if it's not visually, as long as you can see what the expected move is in parentheses or something like that, you should be fine. If you can't see any of this information, get a new broker. So what we want to do now is very simply, this is the strategy. This is what you've all been waiting for. You want to sell one call and you want to sell one put, and that's going to create a range that we want price to stay within. Because when you are buying a contract, you're looking to turn a small amount of money into a lot of money, but in order for that to happen, you need price to move in the direction of that contract, and ideally blow through the actual strike of the contract if you bought it out of the money in the first place, and you want price to keep going as much as possible in that direction. But when you are writing and selling or short options contracts, you're taking the other side of the trade, so you want price to stay away from that contract. Now, we also want to have a high probability of success. Now, because we know what the expected move is of this underlying over the next 31 days, we simply just need to sell contracts outside of this expected move, and that's going to give us a high probability of success. The further out you go, the higher your probability of success, but the less premium you will collect, so the lower your return. So it's a balance between probability of success and return on capital. I like to be around the 1 standard deviation level, or more specifically between 15 and 20 deltas, and that's gonna give you a nice balance. So if we start on the call side, we'll look at the call side, and we have a 16 delta here at the 0.64 strike, which we can sell. And then on the put side, we have a 20 delta at the 0.601, at the 0.605 strike that we can sell. And what you'll notice is that both of these contracts are sitting against the 1 standard deviation level. They are both outside of the expected move, and this is going to give us a nice clean trade setup. So what's the actual probability of this position working in our favor? So if we were to hold this position all the way to expiration, as long as price is within this range that we've just created at the point of expiration, then we're going to keep 100% of the premium that we collect up front. And we also have this green bar that's displayed here. So you'll notice the green bar is actually extending past the strikes a little bit. And the reason why is because we collect the premium up front, and so that needs to be added on to our strikes to get our break-even prices. And the reason why we do that is because the premium is non-refundable. So even if the position moves against us, we still keep that premium no matter what. So our true break-even is going to be 0.64 plus the premium, which is this in the bottom middle, which is 0.0038. So you do 0.64 plus this 0.0038, and that's our true break-even price, whatever that is. That's displayed by this green bar here. So even if price actually moves past our strikes, we can still make money. So what's the chance of making money on this? Well, in the bottom left corner we have our POP, which is probability of profit. That's your probability of making at least 1 penny on this trade. So it's 73%. That's if we hold till expiration. So we've got a 73% chance of this trade working out. And if we wanted to get out of this position at, say, 50% of max profit, we can do that. And we're going to have an even higher win rate. So our P50 number is not displayed for futures, but for equities it is. But basically your P50 is going to be about 10 to 15% higher than your POP. So we'd be looking at a P50 here of about 85 to 90%. Okay, so if you want to get out of 50% of max profit, which is what I personally do, then we'd be looking at a probability of success of between 85 and 90%. And if you want to get out of, say, 25% of max profit, which is perfectly fine to do, you know, you'd be looking at an over 90% win rate. Okay, so you're probably thinking, well, these are very, very high probabilities of this trade working out. So what's the kind of return that we can make? So this is the reason why we chose futures, because of the capital efficiency. So if we look here at our max profit, this is what we're going to collect in dollar terms up front, $380. So if we were to get filled in this position at this current mid price, we would collect $380 up front, and that's going to get added to our cash balance automatically by our broker. So getting out at P50 or 50% of max profit would be 50% of this max profit number here. So that's going to be $190. So at P50 we would keep $190. We'd pay $190 to get out of the trade, but we would have collected $380, so we would net $190. Now our buying power requirement is going to be just over 800. So just on absolute terms, if you held till expiration, we're going to collect 380 and we're going to be using just over 800. So as you can see, we're very close to a 50% return here. So we're getting a very high return on capital, and This is in 31 days, not over the year, but in 31 days. So we're getting a very high return on capital, a very high win rate, and you can even be more aggressive. So if you know you have the edge, i.e. if volatility or implied volatility is very high, you can be more aggressive. You can move to the 23 delta. Say, for example, we'll keep the put side on the 20, move the call side to the 23, and now we're collecting $480 up front, and our buying power requirement's 870. So we're actually getting a over 50% return here, and our pop is still around 70%, meaning our P50 is going to be between 80 and 85%. So you can play around with your contracts depending on how aggressive or conservative you want to be, but this is basically just what you want to do over and over and over again until the odds just work themselves out. If you are looking, so when you're managing your winners, you just want to get out of 25 to 50% of max profit. When you're managing losers, there's multiple ways that you can manage your losers. You can manage, say, so for example, we've got 30 days left on this contract. At about 15 days time, you know, if you're in a little bit of profit but not quite hit the profit target, just take the money and look for a better opportunity. If your strikes are breached, there's so many things you can do. For example, if your call strike is breached and price is moving higher, you can rebalance your deltas by moving the put side closer to the money. You know, you can make the position, you can turn the position into a straddle. You can buy the gut, sell the wings. You can go inverted. You can roll out in time. There's so many things that you can do to reduce that 1 in 10 chance of actually losing a trade. But you know, that's a bonus. You will make money just by simply playing the odds over and over and over again. You get out at a 50% max profit at the latest, or you know, get out at 50% of the amount of time left on the contract. So if you're getting in at 60 days, get out at 30. If you're in at 30 days, get out at 15, for example. Just use your profit targets as a stop loss. You can also use time as a stop loss as well. So you do need to make sure that you are managing your position sizes correctly, because even though you might be managing your trades correctly, etc., if an adverse move happens, the only way you can protect against that is by having a small position size. So you do need to keep your buying power in check, and the way to do that is by using our free position sizing template. The link for it is in the description. The way it works is you just enter in the size of your portfolio. So let's just say you have a $18,500 account. You enter that in, and then below it you enter in the VIX level. So let's say if it's currently at 23.1. Everything's then going to be dynamically calculated for you, taking into account the size of your portfolio and the current VIX level, which is basically just a proxy for the volatility in the market. The higher the VIX level, the higher our edge is, so you can be more aggressive. Also, the higher the VIX is, the lower the chance of a black swan event happening. So that's another reason why you can be more aggressive. So as long as you're following this, you're going to be absolutely fine over the long run. If you would like to learn in more detail, the link will be in the description. This time click on EDS Premium, get yourself signed up. You will have access to this portfolio that I just showed you, or the account that I just showed you in this video, and in there you'll be able to see all the positions that we're placing, how we manage risk, how we make adjustments, all in real time. We have got a position on ZC, which is corn at the moment. This is a small account, and very soon we're going to be starting a 1k to 100k challenge, growing a small $1,000 account using this exact strategy that I showed you to grow it all the way to 100k, and then we'll see where to go from there. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do ever get stuck, you can speak to myself directly or with other like-minded individuals. There's a 100% money back guarantee, so once you have been through the full course, follow some of our trades, and if at that point, if after 6 months you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. It's $9.99 a month to join right now, and the price will be increasing, but once you're in, the price is locked in for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill, and once you've learned it, no one can ever take it away from you. It's a very powerful thing to know. and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.